just to keep in mind. Right. Rental expenses. What do I mean by hybrid model? Hybrid model is along the lines of 3 days in office, 2 days out, or 2 days in office, 3 days out. Okay. So yeah, it is that's the approach that a lot of companies have taken, or alternatively, they've taken a 1 week on, 1 week off approach. There's a bunch of different variations on that theme. Okay. Rental expenses. If you are renting out your property, it's all the expenses that are related to the running of the property. What do you need to pay to have the property in functioning condition that you can rent it out? So it's standard section 11A. It's any expenditure and loss actually incurred in the production of income, not of a capital nature. So yes, it would be your water account, your refuse, your taxes and your rates. Right. Your municipal taxes and rates, all of those things would be deductible for income tax purposes. Yes. The key thing is not capital. So what do I mean by not capital? That is why, for example, your mortgage bond, the capital portion of your mortgage bond is not going to be deductible for tax purposes. It's only the interest, because that capital portion is capital in nature. Ha ha. I mean, it is it's not it provides an enduring benefit. Also, that's also the difference between repairs and improvements, because anything that I do that improves the property, in other words, it adds something that wasn't there before, like expanding the floor space or putting in an additional garage, that kind of stuff, that would be uh, an improvement and therefore not deductible under 11A. That would go to the base cost of the actual building. This is also where I would then go and say the rest of the expenses is going to depend on the nature of your rental agreement. So, for example, if you have bought a property that is in a estate with a security fee and an estate levy, then that is going to be tax deductible, because that's just part of your running costs of the property. If you rent out the flat unfurnished, well, then, replacing the carpets or repainting, yes, that would be a repair, that would be fine. But, that's going to be the limit. If you rent it out furnished and you buy new sheets every time you get it, every 2 or 3 years when you get new linens or whatever else, then yes, that would essentially be part of the expense of providing a furnished property. I'm going to leave it. I'm going to leave that question at that, because, yeah, we still got a lot to go through. The only other point I'm going to make on it is, please, with your movable assets, so either your soft furnishings or your other items, so you would have to consider there which allowance you're going to claim on your assets, because the thing to remember is that if you are providing an asset like your cutlery and your plates and your kitchen furniture and your chairs and desks and linens, strictly speaking, those are assets and not expenses. Because they do provide an enduring benefit. You can use your linens more than once. So when you're looking at your expenditure, you would not be looking at 11A for those. You would be looking at 11E or one of your building allowances, dependent on the nature of the asset. So please just make sure that you're using the correct write-off period for the assets. Okay.